Hello, I'm Neil Whelan, and welcome to the Wesleyan Podcast. This week's edition, brought to you by Wesleyan Financial Services, is, I'm sorry to say, not one of the most pleasant subjects we're going to talk about, but nevertheless it is an important one. What happens to your estate when you die? From inheritance tax to working out what will happen to your practice or business, it's all in here, with Monica Bacolt asking the questions, and Simon Cosgrove, a specialist financial advisor at Wesleyan Financial Services, answering them. As always, though, this podcast is for information only and doesn't constitute financial advice. But if you would like to talk to someone from Wesleyan Financial Services to help plan your finances, I'll be back at the end to tell you how to get in touch. And with that, I'll hand you over to Simon. And first up, Monica.
Simon, thank you so much for joining us today.
Pleasure.
So today we're going to be talking about estate planning. And estate planning is often a somewhat overlooked topic when it comes to financial planning. It is, however, I think important for all of us to think about, what would happen to our loved ones if they were no longer around. So as a dentist, there's certain things that that should be thought of when it comes to estate planning. Do you think you could talk me through what considerations there are for dentists?
Sure. Yeah. I mean, my job is to deal with dentists and provide financial advice to dentists in all areas. And estate planning is certainly one that affects both associates and principal dentists. I think we'll start by just explaining a little bit about what inheritance tax is. So inheritance tax is a tax that may be paid on your estate when you die. And obviously by paying the tax, that's going to reduce how much money is going to pass to your beneficiaries, which could be your children, it could be anyone else. So that's what inheritance tax is. No tax is charged on the value of the estate up to what's called a nil rate band. So everyone's got what's called a nil rate band, which tends to be the first £325,000 of your estate. So anything up to 325,000 is not liable to inheritance tax. If you own your own property and it's your main residence and you're gonna pass it down to a direct descendant, which is children or a spouse, then you have an additional nil rate band, which is called a main residence nil rate band, which will take it up to 500,000 for a single person. So for everyone's got this £500,000 if they've got a main residence. For married couples, anything passes between married couples free of inheritance tax. So it would only be payable generally on the second of you to die. So between the two of you, you have £1 million. So if you are a married couple or you're in a civil partnership, then anything over £1 million is what is potentially liable for inheritance tax. The rate of inheritance tax at the moment is 40%. So if someone has got an estate of 1.5 million, for example, they're a married couple, we know that the first £1 million is likely to be free of inheritance tax because of their nil rate band. Then there's potentially tax to pay on 40% of that 500,000 that's above the million, giving us a tax bill of £200,000. So these tax bills can be fairly hefty depending on the size of your estate. And when we talk about the size of the estate, it's important to remember what's in there because people tend to forget what else can be added. So obvious things like properties, savings, investments. If you're an NHS dentist, then there's potentially the NHS lump sum from the pension, which could be added in the future. There's also future inheritances. So if you inherit from parents or grandparents and they leave you a property or they leave you with savings or investments, then that's going to be included in your estate because then it becomes yours. So think carefully about the size of your estate. Once your estate reaches £2 million, then the additional nil rate bands that we talked about earlier, the main residence one, the additional 175,000 starts to reduce. So it's not something that's guaranteed, this £1 million between a married couple. It's something that, depending on circumstances, is there for everybody. The main thing that I look at with my clients is to plan carefully how much they need in income. in retirement and where that income is going to come from. A lot of dentists that I see have a number of sources of where the income can come from. So NHS pension, if there is one, if there's been some NHS service over the career, some dentists will have more, some will have less, but that will provide a guaranteed level of income no matter how long you live. So that's an important part of the retirement plan. The other main one, certainly for associates, is going to be personal pensions. And this is where you need to be careful, because when we talked about the size of the estate earlier, although the NHS pension lump sum forms part of the estate, what doesn't, until you crystallise them, which means until you access them, is anything that's held in a personal pension. So, for example, let's talk about someone who has got some NHS service. So they've got an NHS pension that will give them £20,000 a year, let's say from the age of 60. And it's not unusual for a dentist to have, say, £500,000 saved up in a personal pension. Until they touch that personal pension, that 500,000 is not counted for inheritance tax purposes. It's outside of their estate because it's held in something called a master trust. Once that pension is touched and maybe a tax-free cash lump sum is accessed or income is taken, then that's going to start to fall into the estate. So that's something to be careful of. So if someone has got savings that they've got, if they've got investments and personal pensions, if they've also got an inheritance tax issue, a lot of the time accessing the personal pensions last of all can be the right thing to do for somebody, which probably sounds a little bit illogical because pensions are designed to pay for your retirement.
Yes, it does sound a bit strange.
It's always a surprise to a lot of my clients, but it's because of the tax efficiency. It's because of the estate planning side of things. And that's where it's important to get advice and to run a cash flow model to say, right, how much income do you need in retirement? What's your expenditure going to look like? How's it going to change? How much is coming from the NHS pension? And what's the difference? When's the state pension starting? Because there might be varying levels of income at different stages of retirement. And if other sources like savings or investments can meet that income, then holding the personal pensions and not accessing them means that they're not going to be taxed and they can pass down the generations without any inheritance tax. So any untouched personal pensions can be passed to spouses, can be passed to children, etc. So they are really tax efficient. So the biggest tip I could give to my clients is to say, well, think carefully about the sources and the level of income that you need and where you take them from.
I see. That's very insightful. That's really, really good advice. Are there any differences for practice owners? I mean, is there anything else a practice owner should be aware of when thinking about estate planning?
The main difference, I mean, everything that we've already talked about is applicable, obviously. The main difference is going to be the sale proceeds of the practice. So a practice owner, generally speaking, is going to sell their practice. Even if they keep the buildings on and take the rent from them, then the funds from the sale of the practice tend to be significant. I've had clients selling practices and receiving anywhere from 300,000 up to 2 million over the last few years. Suddenly, with those kind of values suddenly becoming part of the estate, it's causing them not an immediate issue because inheritance tax is only payable on death, but it's suddenly causing them a problem in terms of what are we going to do with this money? Are we going to use it for income? Are we going to use it for capital? Do we want to lose potentially 40% of a significant part of it in the event of death? How are we going to handle it? So I think that's the biggest difference between associates and practice owners. They will potentially also get the NHS lump sum as well. So there's this huge amount suddenly coming in. And there's a dilemma on what to do with it and how to keep it as tax efficient as possible in the short term when it's providing either income or capital, but also in the long term in the event of death.
Yeah, that sounds like an area for you to give advice on, definitely.
Yeah, and it's something that I do. I mean, a lot of principals come to me and they say, well, I need £70,000 a year in retirement. net. That's how much I want to spend every year, or 60,000, or whatever it is.
Mhm.
How can I best use this practice funds that I've got to create that, but also protect the value of it so I can pass it to my children, to my spouse when I die? Because the one thing we don't know, one thing that is certain is death. The unknown is when it's going to happen. And it could
Mhm.
be within a couple of years of retirement, it could be 20 or 30 years down the line. And that's the problem with estate planning. A lot of people try to put it off because they think it's not an immediate problem. And the
So,
truth is, you don't know whether it's an immediate problem or not.
so would you say the sooner the better for
Well,
estate planning?
yeah. And it can be difficult at the beginning of retirement because you don't know how much you're going to need. You're not going to know how long you're going to live. So I one thing that I can use sometimes with people is just to say, well, think of it in three pots. So pot one is, I'm definitely going to use and need this money.
Mhm.
Pot two could be, depending on how long I live, I might need this money. And pot three is, no matter how long I live, I'm not going to need this money. And that allows people to start to think a bit more clearly. If suddenly someone's got £2 million from the sale of a practice, they might say, well, of that, 500,000 of it, for example, I'm never going to get around to. And to spending. And that could be something to give away or to put into trust or just to get out of your estate in some way. And we'll come back to more effective ways of estate planning shortly. But
Mhm.
it's just the uncertainty of time that makes it a little bit more urgent for people, particularly with the size of the estates that dentists tend to have, because
Mhm.
people's properties have risen in value over the last 20 odd years, whereas the nil rate band, the estate planning kind of threshold, hasn't really moved.
No,
It
no.
was designed to be a tax on the rich, but it's kind of falling. It's catching a lot of people who wouldn't consider themselves to be rich just because of the size of their property.
Yeah, it's definitely worth bearing in mind, isn't it?
Yeah.
And just another quick question. What's the potential impacts of not having a will and sort of in the case of a practice owner, not having robust business agreements in place?
Having a will is strongly recommended just because if you die intestate, so without a will, then the laws of intestacy apply. And it's the difference between making a will where you know who you want to benefit is going to benefit, or relying on the law to say, well, you've got children from a previous marriage or stepchildren. Modern families are complicated. And you might find the law states that it goes to some people and not others who you would want to benefit. So making a will, just make sure the right people benefit based on who you would want to benefit from it. So it is really important. Um, on the business arrangement question, yeah, I think one of the main things to think about is having an agreement within the business, whether you are a partnership in a business or a limited company, whatever it is. It's remembering that the business has got a value. So let's say we've got £1 million dental practice as an example, owned
Mhm.
50-50 between two partners. So each partner owns 500,000. In the event of one of their deaths, the family are going to need that value out of it because it's theirs. It's been left to them in a will, hopefully, but it's part of the family. So having the ability to get 500,000, the surviving partner needs to pay the family.
Yes.
It could have serious financial implications to a dental practice to us saying, well, one of the principals has unfortunately died. We now owe the family 500,000 because that's the value. What do we do? Do we try and sell that half of the practice to someone else to try and get the money? Do we dip into savings? Do we close? Any of these things? I mean, I have heard of dental practices just having to, not many, but having to close because of the death of a principal because there wasn't enough money to pay the family. So having effective planning there. Legacy planning is not just about trying not to pay inheritance tax. It's about making sure that you've got sufficient to pay who is entitled to being paid in the event of death. And owning a practice is one. It's going to be one of the biggest assets, if not the biggest asset, that certainly a principal dentist may have. So yeah, there could be serious implications for a practice if they don't have the right business arrangements. And insurance tends to be the easiest way of solving that problem, just making sure in the event of death, each partner has a value that can be paid immediately to the family, and the practice can just continue without any implications going forward.
Because I suppose if they didn't have the money to buy the family out, that would mean that the family were now co-owners of the practice, and that also could have implications.
Yeah, it could. I mean, they may or may not have training in dentistry.
Yeah.
They might not want to be involved. They might need funds to pay for children's education. They might want a continuing income. Everyone's circumstances are different, and what's right for one person isn't necessarily right for a different person. So it's really important that everyone is considered on their own merits, and in their own specific situation.
Definitely. Thanks, Simon. And just to finish up, what do you think are the most effective ways of estate planning?
There's a number of ways of planning for it. The first one is lifetime gifts. So giving money away while you are still alive, or giving assets away while you're still alive. There are various allowances that people are allowed to give away without any implications. They're not huge, but you need to be careful with lifetime gifts. Some could be chargeable straight away. So what's called a chargeable lifetime transfer, which is where you have to pay inheritance tax while you are still alive because you're giving a gift away.
And when does that apply?
It tends to be if you're giving a gift over the nil rate band. So if you were to put money into trust for someone, for example, of 400,000, that's 75,000 over the nil rate band, which means that 75,000 will be charged at 20%.
Right.
So that's a lifetime. That's a chargeable lifetime transfer. Some could become chargeable if you die within 7 years. So if I give 100,000 to somebody but die within 7 years, that could potentially still be charged for inheritance tax for part of the estate. It's designed to stop people giving money away in advance of their death, or in advance of their death within the next few years. So you need to be careful that some people as well try to give property, or put property into their children's name. So if they've got a buy-to-let, or if they've got a holiday home, they'll say, well, I'll put it in my children's name. It's now not mine anymore.
Mm-hmm.
The danger of that is they continue to visit there for holidays. And if they are not paying a rent, stay there, then it's still classed as theirs, because they are still having use, they're still having the benefit of that asset. They haven't really given it away. So the Inland Revenue can look fairly carefully at things like that. So that's the first thing, giving money away, lifetime gifts, just reducing assets as much as possible. But as we said before, at the beginning of retirement, if you've got all this money, you don't know what you're going to need and what you're not going to need. You could put money into trust, which is another way of giving away an asset, but you maintaining control over it. So if you've got children, you could put money into trust, invest it. You are trustees of the trust, so you maintain control of the money. The children can't go and spend it on whatever children spend money on. But it just makes sure that it's outside of the estate, because it's no longer yours. It's in the trust, so it's outside of the estate. And they would get it when you're ready for them to have it. Another way is leaving at least 10% of the net value of your estate to charity. So if you leave more than 10% of your estate to charity, then you're entitled to a reduced inheritance tax rate of 36% rather than 40%. So it's not a huge difference, but it's still an element of saving, and obviously charity benefits as well. And the other way of doing it is insuring the liability. So if you calculate that your estate is worth X amount and your inheritance tax bill is going to be 300,000, for example, then you could take an insurance policy out that pays whenever you die, whether that's in 3 years' time or 30 years' time. It's guaranteed to pay 300,000, which just means they have got the inheritance tax bill that's paid immediately. They've got the money to pay it. Because one thing that a lot of people don't think of is when you die, your legal representatives are going to deal with your estate, and they're liable to pay any inheritance tax that's due. Normally, it's got to be paid within 6 months of your death. Your legal representatives can only deal with your assets when a grant of representation, which is issued by a court, is issued. But they can't issue the grant until the inheritance tax has been paid. So normally, although the assets are there, your legal representatives can't get at your assets to pay the inheritance tax bill because a grant of representation hasn't been issued.
I see.
So it's a bit of a dilemma for a lot of people. So they might need to use their own money, take out a short-term loan just to pay the tax to be able to then get at the assets.
Mm-hmm.
So that's just something to be aware of as well. But having money in an insurance policy, for example, in trust, just means that the money is already there.
And it makes it, sorry, Simon, just going to say it makes it easier, I guess, at an already very difficult time, very upsetting time.
That's the other thing to think about. Yeah. Are you going to be wanting to worry about where are we going to get this £300,000 tax bill before we can get the assets? So having an insurance policy is a good way of doing it. It's almost like paying your inheritance tax bill by direct debit while you're still alive. You pay a monthly amount and it's guaranteed to pay the tax bill at the end.
Mm-hmm.
So yeah, I mean, inheritance taxes and estate planning is a complicated area. It's an important area because it could significantly reduce the amount that's passed to beneficiaries. Now, there has been talk over the last few months that the government might get rid of inheritance tax. It might be abolished. It might be changed. And yes, it might be.
Mm-hmm.
The worst that can happen is we're talking about legacy planning. So even if inheritance tax is abolished, and if we get a change of government, it will probably come back in anyway. Even if it is abolished, whatever you've put in place, whether it's an insurance policy, whether it's money into trust, whether it's giving money away, it just means that your beneficiaries are still benefiting from it, whether there's inheritance tax to pay or not. It's still getting to the right people at the right time. So I wouldn't worry too much about whether it's going to be abolished or not and whether you need to do anything, because laws change regularly over the years, and it'll change many times in terms of the amounts, whether it's in or out over the years. So just make sure that your assets are arranged effectively, and make sure you think of any future changes as well in terms of inheritances that you might get.
That's great. Thank you, Simon. That's really, really helpful information. And unfortunately, we've run out of time, but we'll have to have you on the show again soon. Thanks very much for coming on. Thank you.
And that's our show for this week. Thank you to Monica and Simon. If you are looking for expert financial advice for you or your practice, go to wesleyan.co.uk, where you can book a no-obligation appointment with one of our specialist financial advisors. As for finding out what Wesleyan is up to more generally, you can find us on Twitter/X and Facebook, Instagram and LinkedIn. And if you've listened to the end of this podcast and you found it useful, you can like and subscribe to us on all the usual platforms, as well as finding us on YouTube, where there's a whole library of videos covering a wide range of financial planning topics. But that's it for now. So until next time, thanks for listening.